All right, aspirants, welcome. We are diving deep into one of the most critical chapters of the economic survey today, monetary and financial sector developments. Let's get right into it and break down the essential numbers, the key trends, and all the concepts that you absolutely need to nail for your exams.
Okay, let's kick things off with a number that honestly tells an incredible story. 2.6%. That's the gross non-performing asset ratio for India's banks, and it's at a 12-year low. This is a massive deal. It's a powerful signal of a healthy, clean, and really resilient banking sector. And what does that mean for you and me? It means our banks are stronger, they're more willing to lend, and that fuels growth for the entire economy.
So here's how we're going to tackle this. This is our roadmap for today. We're going to start with the big picture scorecard, then we'll get into the RBI's game plan, check the health of our banks, see what's up with the booming capital markets, look at the safety net, and finally wrap up with the outlook. Let's go.
First up, let's look at that financial scorecard. You know, if we had to boil it down, there are two huge stories here. One is just strong, solid growth across the board. And the second? A major leap forward in what we call financial inclusion. We're talking about bringing more people into the formal banking system than ever before.
So check out this number, 64.2. This is the RBI's Financial Inclusion Index score for March 2024. Now that might just sound like a number, but get this. Just 3 years ago, it was way down at 53.9. That is a huge jump. It's solid proof that financial services are finally reaching way deeper into the country, empowering more people with access to things like credit and savings.
Okay, so we've seen the big picture on inclusion. Now let's zoom into the economy's nerve center, the Reserve Bank of India. We're going to unpack the RBI strategy, which is always this delicate balancing act, right? They've got to keep prices stable and control inflation, but at the same time, they need to make sure the economy has enough fuel to keep growing.
This slide basically lays out the RBI's entire playbook for the year. The repo rate you'll see is holding steady at 6.5%. But look at the big shifts. The policy stance moved from withdrawal of accommodation, which is just a fancy way of saying they were tightening the money supply, to neutral. And when you pair that with a cut in the cash reserve ratio, what do you get? A planned injection of over 1 lakh crore rupees of fresh cash right into the system.
Now this next one is a concept you absolutely have to know for your exams, the money multiplier. Don't let the name scare you, it's not as complicated as it sounds. All it really tells us is how much the money supply can expand for every single rupee the RBI puts into the system. You can think of it as the banking system's superpower to create credit. And what's the result of all this? Well, you can see it right here in this chart. The money multiplier has been climbing steadily, hitting 5.7 in December 2024. This means our banking system is just getting more and more efficient at creating credit and liquidity from that base money the RBI provides. And that, in turn, fuels more economic activity.
Okay, so how do you remember this for the exam? I've got a great little mnemonic for you. Just remember, CR leaks. Think of it like a leaky pipe. When more cash is held by the public or more reserves are held by the RBI, that's money that isn't flowing through the system and being multiplied. These leaks actually shrink the overall effect. Okay, let's shift gears and move to the very heart of the financial system, the banks. And the story here, honestly, is one of a remarkable turnaround. We're talking about better health, higher profits, and a much stronger foundation for future growth.
This visual tells such a powerful story. I mean, just look at that dramatic drop in gross non-performing assets, or, bad loans. We went from a peak of 11.2% back in 2018 all the way down to that 12-year low of 2.6%. This isn't an accident, it's the result of a very systematic, very deliberate cleanup of bank balance sheets.
And here's the other side of that same coin. As the bad loans have vanished, the bank's own capital buffers have gone up. The capital to risk-weighted asset ratio, or CARR, is now at a super healthy 16.7%, which is way above what's required. So what does this mean? It basically means our banking system can take a punch, it's much more resilient to any future economic shocks.
So all this healthy credit, where is it flowing? This comparison highlights a fantastic trend. Credit to our micro, small, and medium enterprises, which are really the engine of job creation in India, is growing at 13%. That's more than double the rate for large companies. This is absolutely vital for inclusive growth. Now, you might be asking, what drove this massive turnaround?
Well, a huge part of the credit has to go to the Insolvency and Bankruptcy Code, or IBC. The IBC has been a total game changer. It fundamentally changed the rules of the game between borrowers and lenders, creating real credit discipline and a clear process for sorting out problems. It's a key reform, no doubt about it.
All right, next up, let's turn to where the action has been hottest, the capital markets. They have been on an absolute roll, driving a major trend called financialization. It's a bit of a fancy word, but all it really means is that more and more people are moving their savings away from physical things like gold or property and into financial assets like stocks and mutual funds.
Okay, get ready for this, because this statistic is just mind-blowing. In 2024, India accounted for nearly a third, 30%, of all initial public offerings, or IPOs, in the entire world. We are now a global leader in raising capital, which just shows you the immense confidence the world has in the India growth story. And who's participating in this story? 18.5 crore. Just let that number sink in. That's the staggering number of Demat accounts we have in India as of December 2024. It shows this massive surge in regular people, retail investors, getting into the market. That number jumped by 33% in just 1 year. Incredible.
And here's another key mnemonic for you. SIP powers the market. The incredible rise of systematic investment plans is kind of the secret sauce behind our market's resilience. You've got millions of Indians investing a little bit every single month. This creates steady, strong domestic demand, which means we're much less dependent on the whims of volatile foreign money.
Now, beyond the high-energy worlds of banking and stock markets, there's the critical financial safety net. I'm talking about insurance and pensions. Now, these sectors are growing for sure, but the really important thing to understand here is the massive, massive runway they have for future growth.
This table lays it out perfectly for us. Look at insurance penetration. It's just 3.7%. That is about half the global average. And it's a similar story with pensions. While the number of subscribers is growing, the overall coverage across the country is still pretty low. For policymakers, this signals a massive opportunity and a critical area of focus to make sure our citizens have a secure future.
Okay, understanding this distinction is really crucial, especially for your exams. A lot of old systems around the world were pay-go, or pay-as-you-go, but these can become super unstable as populations get older. India's national pension system, the NPS, is a defined contribution model. It's a much more modern and, crucially, a much more fiscally sustainable model for the government's long-term finances.
All right, let's bring it all home. Let's consolidate everything we've talked about and look at the path ahead. What's the outlook for India's financial sector, and what are the key trends and, potential challenges that we really need to keep an eye on?
Okay, people, this is the slide. If you're going to screenshot one thing from this whole session, this is it. Go ahead and pause here if you need to. We've packed in every single major data point we discussed, from the 2.6% GMPA ratio all the way to the 18.5 core Demat accounts. It also recaps key concepts like the IBC, the money multiplier, and all the new jargon. This is your ultimate cheat sheet for the exam.
And this really brings us to the fundamental question facing India's policymakers as we look to the future. We have this incredibly powerful engine of growth in our financial sector. So the great challenge now is, how do we nurture all this incredible innovation while also making sure the system stays stable and actually serves the real economy? That is the tightrope we must walk on the path to 2047.